So today we'll be learning IAS 37 provisions, contingent liabilities, and contingent asset. So a provision can be defined as a liability of uncertain timing or amount. Yani, it is a liability. Let's say there is a liability, but we don't know when that liability is going to be there. It's just the timing and how much the liability is going to be. There is some kind of uncertainty in it. In such
Mhm.
cases, when such liabilities arise, we will have to give provision for that. One example would be dismantling cost. We already know that, right? Because
Mhm.
in case of dismantling costs, all those amount and all, it's just an assumption. We don't know exactly how it is going to be. It can be more than the amount that we have estimated, or it can be lesser than that. But still, we'll recognize the provision because that liability may arise. Sometimes we may not have to dismantle at all, but still we'll just foresee it and will recognize a liability. Okay, so yeah, it is. Wait. Okay, this is the definition of provision. Okay, now recognition criteria. So every standard has a recognition criteria as well, but in provisions case we have a different one. Because in usually the recognition criteria, what it is probable that future economic benefits can be, all those things are there, right? Can be
Mhm.
expected. Those are the recognition criteria. But in this case of provision, the first criteria is that the entity has a present obligation, legal or constructive obligation. Any of it present, this obligation should come last. Okay, present legal or constructive obligation. Yani they have already a obligation now. Let's
Mhm.
say I give an example of legal can be another dismantling cost itself is a present obligation. And I bought a plant, so I will have to dismantle it after a couple of years. So right now I have obligation, right? After 5
Mhm.
years that I have an obligation of dismantling that. So there is a present obligation at the year end, or it can be a legal obligation like any lawsuits, and if somebody filed a case against us. In such cases also we'll have to provide a provision. Or it can
Mhm.
be constructive. A constructive provision, you have it in the next slide, we'll see it. Okay, and second criteria is that it is probable that the transfer of resources embodying economic benefit will be required to settle it. Basically it's just that we will have to probably any the percentage should be, it must be more than 50% chance that we will have to settle it with some kind of amount. That's why transfer of resources embodying mostly like we have to pay cash. We'll have to settle, we have to give an amount for that to settle this obligation. And reliable estimate can be made of its amount. It's not like we need to provide accurate estimate, but we should be able to provide a reliable estimate of whatever the obligation is. Okay,
Mhm.
now constructive obligation. Now, constructive obligation arises as a result of established pattern of past practice, published policies, or sufficiently specific current statement that the entity has indicated to other parties that it will accept certain responsibilities. So basically, it's like, let's say our company has a policy of, if let's say, what can it be? Okay, let's say I'm selling some goods. So my company's usual policy is that if that goods have been, there is some kind of defect or something within, how much ever it is, I'm not going to give it for 1 year, 2 year. Throughout the life of the throughout the life of that good, I told the customer that whatever happens, I will return it to you. I will pay back like a warranty, but I'm not giving any kind of you know 1 or 2 years or 3 or 3, nothing like that. It's just that I have a past practice that whatever defects happens to the goods I've sold, I have a habit that I will return, give them a new good instead of that. Okay,
Mhm.
or it can be, we have we have policies like that. It can be environmental thing. Let's say our entity has a policy that if anything happened to the environmental damages, anything had been there, so I will do any, I will settle that thing, I will correct that thing, or I'll pay amounts and all such thing. Maybe something policies and all are there, that we are not going to destroy the environment, or some kind of obligations. Those are constructive obligation. It's not legal. It's not like coming out of nowhere. It's just because of our past practice or our policies, or it's just and here there is a sufficiently specific current statement the entity has indicated. Yani, maybe I have told one customer, not like to the entire customer, that if this happens I will do this. And it's like it
mm,
maybe also can also arise out of the statement or out of whatever we have told the customer or something like that. So constructive obligation, it's basically coming out of our practice, policies, or any statements that we have given to other parties. Understood?
yeah.
Okay. Now measurement of provision. Now in case of provision, amount recognized as a provision should be the best estimate of the expenditure, because we can't give accurate estimate, but we should be able to give best estimate of the any kind of obligation that we have to settle at the end of the reporting period. So amount should be recognized as provision should be the best estimate of the expenditure. Now, where the provision being measured involves a large population of items, the obligation is estimated using expected value. Now, this use of expected value mostly comes in case of warranties and all. Yani, it's like if there is, let's say, I have given warranty, I'll be like, there is 50% chance that most people is going to claim this warranty, or so this much people is going to claim warranty between this time period. So usually, expected value thing you can only be used, not can only, mostly in questions and all, you will have to use it in cases of warranties.
Mm,
Expected value is basically multiplying the probability, the percentage to the value and all. So you'll take the sum and all. I have included a question in this so you can understand it better. Okay, let's say Hopewell sells a line of goods under 6-month warranty. So any defect arising during this period is repaired free of charge. Okay, during the 6-month warranty, any defect will be repaired free of charge. Now, Hopewell has calculated that if all the goods have sold in the last months of the year required, the cost would be 2 million. If all these goods had more serious faults and had to be replaced, then the cost would be 6 million. And they are telling you that the normal pattern is that 80% of the goods sold will be fault free, and 50% will require repairs, and 5% will have to be replaced. So in case of fault free and all, we don't have to provide a provision. So there is 50% chance that we will have to repair it, and there will be 5% chance that we'll have to replace it. And they're telling you that the amount cost would be, if we have to repair all the goods that were sold past 6 months, it would be 2 million. Yani out of the 2 million, there is 50% chance that we have to give the repairs. Now, if
mm,
all the goods have been sold, more serious faults have been there, we have to replace it, and 6 million. And the percentage would be 5% to replace it. So, in
mm,
order to find expected value, it is simple. Just 2 into 15 percentage plus
mm.
6 into 5 percentage.
5%. Mm,
That would be 0.6 million. So they are asking you how much provision you should give. You should give 0.6 million. So in case of expected value thing, this is normally how questions will come. You will
mm,
have, they'll give you few data like this is the amount and that is the amount. They will also give you the corresponding percentages. So you just have to find what percentage where to apply and just multiply it and add all those things. Like here, I multiplied 2 into 15, 6 into 5%, and I added them both. Okay, and this is how you find the in cases of warranties and using expected value, this is how you find how much provision you should provide. Okay,
mm,
now measurement of provision. Now, the effect of time value is material. The amount of provision should be present value of the expenditure required to settle the obligation. The great example would be what we know, already know this thing.
Dismantling cost.
Yes, dismantling cost, because dismantling cost is like way into the future. So the effect of time value is material. So in such
Mm,
cases, we have to find the present value. Okay, I have a question here.
estimated that it will cost 3 million to restore the land when drafting is completed in 5 years. Cost of capital. We just have to multiply 3 million with the present value, right?
There is a twist here actually. Yeah, we have to multiply 3 million with 0.713. But remember, when did we buy drilling commenced,
First
on
July.
1st, okay, on 1st July. So on 1st July we will recognize, capitalize this thing, and will recognize the provision, which is, will recognize 3 million into 0.713. But as time passes, as months passes, and it reaches 31st December, something else will be added to it.
Interest.
Yes, interest. For how much months?
6 months.
6 months. So you have to do. You should add the interest to the provision that you have recognized as 1st July.
Okay, I got you. 2.244.
Okay. For on 1st July, how much did you get?
You mean interest?
Yeah. No. No. On 1st July, you recognize the provision, right? So how much did you?
2.134.
Okay. 2.134. It's 3 into 0.713, right? It's
2.13139.
2.139. Okay. And the interest,
0.105.
uh, recalculate it. I'm getting something else. For
Mm-hmm.
2.319s, you will add interest on 2.319.
Oh, okay.
You can't add interest on 3 million, right? 3 million is like future value. So you will add interest to the present value.
Oh, I got you now. 7 years.
Yes. And don't forget to time a portion.
Sorry?
Don't forget to time a portion. The
Time of
interest.
question. Yeah, okay. 0.0749.
Yeah, it's 0.0749 plus 2.139. You will get around 2.2139. So that will
Hmm.
be the amount of provision you will recognize at 31st December 2018. Okay. Okay. Next one. Provision should only be created for unavoidable obligations. So, if there are avoidable obligations, you should not create provision for it. Okay.
Hmm.
So, whenever you see an obligation, you should identify whether it is whether it is unavoidable or it is avoidable. All right, and only then you should create a provision. Now, provision should not be recognized for future operating losses. It doesn't mean that because there is going to be loss in the future, it's not like we have a liability now, right? For losses and all, we don't have to create liability now. Those are future operating losses. We don't have to create provisions for future operating losses. You can
Hmm.
expect these kind of questions for MCQs, for future provision for, like you may have them ask you to state true or false and all.
Hmm.
Now, journal entry to record provision would be debit, expense, and credit provision. We already did this. In case of dismantling cost, it would be debit the asset and credit the provision. And then after interest, at the end of the each year, interest will add up. In such cases, debit, interest, expense, and credit provision. So usually provision is credit in nature because it's a liability anyway. Okay. Now, onerous contract. Now, onerous contract is a contract in which the unavoidable cost of fulfilling the terms of contract exceed any revenues expected to be received from the college. It's mostly like the cost is greater than the benefit we can expect from that contract. Okay, in such contract, we have to recognize a provision for onerous contract. Okay, we will have to measure the obligations from the contract, and we should recognize it as a provision. So what is an onerous contract? Those contracts where the cost from the contract is greater than the revenues that can be expected from the contract. Okay,
mm,
so we'll have to recognize a provision for onerous contracts. Now, restructuring provision. Now, these are some examples where you should provide provision. Previously, you have seen warranties, dismantling cost, and then now you have seen onerous contract. And now, next provision in case of restructuring, you will have to provide provision. Restructuring, as per IAS 37, it is defined as a program that is planned and controlled by the management and materially changes one of the two things. It should be planned and controlled by management, and it should change either one of this. First one, the scope of the business undertaken by the entity, the way that the business is conducted. Either one of this should change. Okay,
mm,
in and only then we can tell it is we can tell it is restructuring. For example, would be sale or termination of a line of business, the closure of a business location in a country, or like entirely changing the industry. Some now we are, let's say we are producing, let's say we are making dolls today, and we plan to change, and we decided to change to food industry. So there is a
mm,
complete change in the way, scope of the business undertaken and the way the business is conducted and all such thing. So in such cases we call it as restructuring, and we will
mm,
have to give provision for restructuring. Okay, but to give provision for restructuring, these two things must be satisfied. The first thing is the entity must have detailed formal plan for the restructuring. They should have the plan on how they are going to restructure the organization, or how much people they're going to terminate, how much redundancy cost they will be paying, and all such details. They should have a detailed formal plan for the restructuring. Okay,
mm,
and the second thing is that the entity must have announced to those affected by the restructuring. Basically, the employees, they should have announced to the employees that, see, we are terminating this line of business. So these people will be affected, and you guys will have to be terminated. All such announcement should be done before the year end. Okay, if it is not done before the year end, then they do not have any kind of obligation at the year end, so they can't provide any kind of provision in that year end. Okay, so before the year end, they should have a detailed formal plan, and they should announce to those affected by the restructuring. These two are very important, and only in this case, and only if these two are satisfied, we can provide any kind of provision for restructuring. Okay. Now, second one is that for restructuring, we will have to provide a provision, right? So in that provision, the two mainly two types of costs are included: the redundancy cost and the lease termination cost. These are the main two main costs that we will include in when we are providing restructuring provisions. And they're telling you that provision should only include direct expenditures arising from restructurings, and cost associated with the ongoing activities of the entity is not included. There's example, you'll see it in the next slide. Okay, so basically we can only include direct expenditure relating to restructuring. Okay,
mm,
and main two types of cost included would be redundancy cost and lease termination cost. uh, may you mainly have to remember only these two, because if they're asking you, they might give you a couple of costs and ask you to calculate the provision. You will have to just remember these are the only two costs included. Okay, they'll give some other cost too. For example, these three costs must not be included in the provision for restructuring. First one would be retraining and relocating continuing staff. Yani, let's say we are terminating a line of business. So what we're doing is we're not completely terminating all the employees. Some of the staff we will relocate them somewhere, or we will retrain them for something else. So all those costs relating to this continuing staff, retraining and relocating of continuing staff, should not be included in the provision. Okay, now marketing. Okay, marketing cost should not be included in the provision. Let's say we are completely changing our industry, so we might do some marketing. See, let's say in our example, I'll start marketing about my new food company, food factory. with my new foods products and all. So all the marketing costs related to it should not be included. Investment in new system and distribution networks. Let's say I invested new system for, say I changed my industry from making dolls, from now I'm making foods. So I might buy new stuffs, new systems, or I might invest in some new distribution networks and all, so that I can distribute my foods and all retailers and all these people. So any kind of investment in such things should not be, any cost relating to related to that should not be included in the provision. Just remember these three things: retraining, marketing, investment in new system. And what should be included was, what are the two costs that should be included?
Included.
Yeah, if you remember, we discussed this in the past, this previous slide.
Return. Okay. Mhm.
Okay, these two things, remember that. So what are the costs to be included?
Redundancy and lease termination.
So what should not be included?
Training cost, marketing cost,
Yeah, and
investment something.
yeah, investment in new systems. Okay. Okay, so is that okay? Provision for restructuring.
Yeah.
Okay, so about onerous contract, what is an onerous contract?
Mhm.
Onerous contract are those contract where the cost is greater than the benefit. Just remember it like that.
Okay.
Okay,
Hmm.
cost related to the contract is greater than the benefit from that contract. Okay,
Hmm.
and what else did we say? Yeah, okay, that's enough. And okay, now, okay, next part in provision is IAS 37. You know the full form of IAS 37 is provision, contingent liabilities, and contingent asset.
Hmm.
Now, provision we have covered it. Now we have contingent liabilities and contingent assets. So for contingent liabilities, we have two definitions. Okay, the first one would be that it is a possible obligation. You know, in case of provision, it was not possible. Instead, it was another thing.
Probable.
Yeah, probable. So in case of possible, the chances are like less than 50 percentage, but more than 5 percentage. Okay,
Mhm.
5 to 50 percentage, some in that range, that is called possible obligation. So
Hmm.
it is a possible obligation that might be arising from past events, and its existence can only be confirmed by the occurrence or the non-occurrence of uncertain future events, and not wholly within the control of the entity. Yani, we can only confirm that this event or this obligation exists only if that future event happens, only when that future event happens. So right now we are not even sure about it. It's like the uncertainty is so less. It's not, if it is probable that it's 50, if there are chances like it's more than 50% chance that it's going to happen, we know some kind of certainty is there.
Hmm.
It's not accurate, but still some kind of certainty is there. But in case of contingent liabilities, and there is another thing, contingent asset, the obligation or the asset is being, it's only possible, we can't confirm its existence until and unless that uncertain future event happens, and it is not under the control of entity, not
Hmm.
wholly within the control of entity. Or contingent asset, it can be also be told as it is a present obligation that arises from past events, but it is not recognized. Yani, the one definition is that it is a possible obligation and we don't know whether it will happen or not. Or it can be a present obligation. You know, there is an obligation right now that arises out from the past events, but it will not be recognized because two things are there. First one is that it is not probable that an outflow of resources, yani, it is not probable that we'll have to pay cash, we'll have to settle this with some kind of amount. Or the amount of the obligation cannot be measured. Remember the three criterias we had for recognizing provision. It should be, there should be present obligation, there should be a transfer
Investment.
of resources, and the reliable estimate can be made. Okay, Three
Mhm.
criteria are there. In case of contingent liabilities, the first criteria that it is a present obligation is satisfied, but the other
Mm.
two are not satisfied. That is, it is not probable. Yani the probable outflow is not there. Okay, we don't know whether the amount of cash will be there will be an outflow or not. Or the third one, that is the amount of the obligation, we cannot measure it reliably. Or so in that such cases, those present obligation becomes contingent liabilities. Okay, but if we can determine these two, if it is probable and if we can determine these two, then it becomes provision. We'll
Mm.
have to give provision, otherwise it will become contingent liabilities. So contingent liabilities have two definitions. The first one is
Yeah.
that it is possible obligation. We
Mm.
cannot determine whether it will happen or not. Second one is that there is an obligation, it's not possible, there is a current obligation, but then the other two criteria are not met, the probable outflow and the measurement of reliable measurement. Okay,
Mm.
understood? Clear, or should I explain it again?
Yeah, yeah, it's fine.
Okay, now contingent asset.
I need to remember all these definitions.
Nah, just understand the concept. That's it.
Okay.
You
Mm.
know, for problem calculation type thing, you will okay. There's a table. Just I have that table. Just when you should recognize the
Mhm.
profession. It's not a big thing. That table is
Mhm.
really small. It is there from the knowledge level paper. A table is there. So that table,
Mhm.
just know it. You can do the calculations and all. Now all these things is it's just that you are learning a standard, right? So you should know what a
Mhm.
contingent liability is, what a contingent asset is, what a provision is, how you should record provision, right? So you should have a knowledge of the standard. That's why all these definitions are being discussed. So
Okay.
contingent asset, it is a possible asset that arises from past events, just like this contingent liability. Remember the first definition, it is a possible obligation, but in case of contingent asset, it is a possible asset that arises from the past events, but we cannot
Mm.
confirm its existence, because we can only confirm it by the occurrence or non-occurrence of uncertain future events. Okay.
Mm.
um, okay, so the only difference is this asset, but in case of contingent liabilities, it is an obligation. Contingent asset, if I am going to give you an example, that would be, let's say I filed a case against my supplier for giving me defective products, giving me defective raw materials. Okay, but it is not it's not probable that I can but I cannot determine whether I will win the case, because if I win the case, I will get compensation. So that
Mm.
compensation is a contingent asset. Depending upon its probability, and only I can recognize it as an asset, otherwise it will become contingent asset. So in case of contingent asset, you will see the table, and then you will understand when to recognize it as an asset, or when we should ignore it. Okay, so basically it is a possible asset that will get. Like example, the main example is this: we filed a case against someone, and we are going to get some kind of compensation or something like that. Okay, now this is the table that I have been talking about. Can you see the fonts virtually
Yeah.
certain? Okay.
Mm.
Okay, based on probability, we have contingent asset. So based on probability, we will see how it is treated, contingent liabilities and contingent asset is treated.
Mm.
Okay, so treatment of contingent liabilities and contingent asset depends on the probability of the occurrence.
Mm.
So just a minute. Hello.
Yeah, yeah. Mm.
uh, it was my nephew.
Okay,
Okay.
okay. Mm.
Okay, now, yeah. So okay, now this is the probability. All these probabilities, you have different names for different ranges, and then depending upon that, you will treat like this liabilities and asset. So the first one would be virtually certain. Okay, These names are according to the standards, so just remember it. So virtually certain means it is like 90, more than 95% sure, we are sure that there will be a liability, or we are going to win the case, or we are going to get the compensation, or else we have to pay the compensation, means it becomes a contingent liability, or if you are going to get the compensation, it becomes contingent asset. So if it is virtually certain, if it's like more than 95% sure that it is going to happen,
mm,
then we will recognize a provision. Okay.
mm,
Otherwise, if in the case of contingent asset, we will recognize an asset, yani the compensation that we have to get from a supplier, let's say it was $300,000, so we will recognize that $300,000 as an asset. Okay. In case of let's say our customer has filed a case against us, and we'll have to pay compensation of $300,000. So in such cases, and if it is virtually certain that we have to pay the customer that amount, in such cases we'll recognize a provision, because there is a liability now. Okay.
mm.
Now it is probable. Probable means 51 percentage to 95 percentage, because if more than 95 percentage is certain, virtually certain. Okay.
Yeah.
So if
Mm,
it is probable, in case of contingent liabilities, we will recognize a provision. So we already
mm,
know that provision means what? If it is probable, we will have to recognize a provision. So in case of any liabilities, contingent liability or usual liabilities, if it is more than 50 percentage, we will have to recognize a provision.
mm,
Okay. In case of contingent asset, we will not recognize anything. We'll just give a disclosure in the notes to accounts. We'll just say, see, here there is a compensation that we have to get. So we'll just give a detailed disclosure of it,
mm.
of the case that we have filed against supplier. Now it's mostly because of the concept of prudence. We will just we will recognize all the expenses and whatever outflow, but
Losses.
we won't recognize, yeah, but we won't recognize all the incomes and all. So that's why they're doing it in such ways. Okay, we don't want to overstate assets and all.
Mm,
So, and then it is possible. In case of possible, it means 5 to 50 percentage, we will just give disclosure. Okay, that there is such as a liability, there is someone has filed a law against us, someone has filed a case against us, so we'll have to disclose that in the notes to accounts, because shareholders would want to see it, right? Yeah, because
yeah.
they want to know it, if there is any kind of liabilities or not. But in case of contingent asset, we will ignore, we won't treat, we won't do anything, no disclosure, no recognition, we'll just ignore it. Okay.
Mm,
If the chances are remote and it is less than 5 percentage, we will ignore it. Be it liability, be it asset, we will ignore it. Okay.
mm.
So okay, just go through it and I'll just simply ask you. Okay, how about that? No, it will just, you can by heart it right now.
Yeah, yeah. Yeah.
Okay, so let me change the slide. Okay, let me ask you. So in case of contingent asset, the probability would be possible. So what? How will you treat it?
Disclose.
The probability is possible.
Possible. Or fight or
Yeah.
ignore.
Okay. So in case of contingent liability, the probability is probable.
Probable. Disclose. Uh, uh,
No, no,
no.
it's no more than in
Mm,
case of any kind of obligation. If it is more
mm.
than 50 percentage, what will you do? It's a liability more than 50 percentage.
Provision.
Yeah, provision. So
Mm,
okay, so remember, if it is for liabilities, more than 50%. So virtually certain, probable, we will give provision. Okay. In case of contingent asset, if it is probable, what will you do?
Disclose.
Yeah, if it is virtually certain,
Asset.
and if it is remote,
Ignore.
and if it is possible,
Ignore.
and if it is in case of contingent liabilities, the chances are possible,
Disclose.
and if it is remote,
Ignore.
yeah, ignore. Learning that table is important. Okay.
Mm.
Okay. That's it. About IAS 37, those are the only
Mm.
things that you should know, and other things you will learn while you do provision. How I know calculations and all, you will know how to do things and all. So we have discussed the recognition criteria. Yeah, that is that they should entity should have present obligation, and it should be probable that there will be an outflow, and the reliable estimate can be made. And we talked about measurement of provision. We should always be able to give best estimate of the expenditure, of the obligation. We should always be able to give best estimate of the obligation. Now, if there are large populations of items, we will use expected value. An example would be warranties. Now, if
Mm.
if there is time value materiality, then we'll have to find the present value. Example like dismantling cost. And when
Mm.
we told that yeah, provision should only be created for unavoidable obligations, and if the obligation is avoidable, we will not recognize provision. And
Mm.
provision should not be recognized for future operating losses. And then we discussed about onerous contract. What is onerous contract?
You told me. I forgot again. Something is greater than something.
Yeah, you know, okay, just think about it.
Cost is greater than benefit.
Yeah, cost is, that's it, that's the thing. Cost is
Okay.
greater than the benefit, or
Okay.
whatever income we are getting, because only in such cases there is a liability, right? Because
Mm.
cost is big, there is more cost there, so in such cases we'll have to provide provision. And then we talked about restructuring. And there were two things that should be there, which is mandatory and only before the year, and it should be there before the year, and it should happen before the year. Only then we can create provision for restructuring. What were the two things?
It must be reasonably possible, probable.
No, 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 no. There should be, in order to have an obligation at the end of reporting period, the entity should do two things: about the
Mm.
formal plan, detailed formal plan of how they are going to restructure. And I told you this, right? And the second one would be announcing to those employees being affected, to whoever is being affected. Wait, wait, where is that slide? Yeah, this one. The entity must have detailed formal plan.
Mm-hmm.
Okay, these two are really important. Okay, these two points are really important. And only then, because in some cases they will give you a scenario, and you should be able to identify from the scenario whether they have their detailed plan, and whether they have announced to those affected. And only then, if they told you to they've asked you whether you should recognize the provision or not. In such cases, you should check out whether they have planned or whether they have announced, or these, if they have done these two things, okay, we can recognize the provision, otherwise we can't. Okay.
Mm.
Okay, then we told about the cost to be included and not to be included. What were the two main costs that should be included?
Included.
Yeah,
Uh, redundancy cost,
yeah,
something
uh,
lease termination cost.
yeah. Let's say I have a shop, and I'm doing it. I've taken that shop on lease. So
Mm.
while terminating, like, if we are terminating those lease beforehand, yani before the lease period, we'll have to pay
Mm.
some kind of cost. Okay, that is called lease termination cost. So these two things can be included. and direct expenditures from the restructuring campaign included, and costs associated with ongoing activities not included. And there were like three costs which should not be included. What was that?
Training, staff training cost, marketing cost, and some investments in
New
new
systems.
systems. Yeah.
Okay. And yeah, we talked about contingent liabilities, two definitions. It can be possible obligation. We can only determine the existence if the even happens. And then we told about present obligation. Yani there is obligation, but
Mm,
other two criteria of the provision is not met. That's why it became a contingent liability, which is the probable outflow. It is not there, and the cost amount cannot be measured. So in such cases, it will be recognized as contingent liabilities. Then we told about contingent asset, which is also a possible asset, and the existence cannot be confirmed. Then we discussed the
mm,
table, and yeah, that's it. IAS 37. Okay. IAS 10. Okay. IAS 10. Okay. IAS 10 means events after reporting period. So basically, let's say our year beginning is 1st Jan. Okay. And our year, basically our reporting date would be what?
31st December.
Yes, 31st December. Now this is the reporting date, the end of the year end. Okay. Then after a couple of months, let's say on 31st March, that is the date when we are going to authorize the financial statements after audit and all those stuff. On 31st March, we are going to authorize the financial statements.
Mm,
Okay. So this period, this is the reporting date, this is the authorization date. So the period between the reporting date and the authorization date is what events after. It is called subsequent period. So any events occurring in this subsequent period, yani between the reporting date and authorizing date, these are called events after reporting period. Okay.
mm,
So if this happen
so,
and okay, that's it. It is here. Events occurring after the reporting period are those events that occur between the end of the reporting period and the date on which financial statements are authorized for issue. And we have two types of events that can happen. Okay, we know there are some events are going to happen between this period. It can be adjusting events, or it can be non-adjusting events. Okay, adjusting events means we will have some kind of evidence that it existed. Yeah, example would be like receivables. Let's say I have a customer and he owes me how much? $50,000.
mm,
Okay, he owes me at the end of the reporting period. I would have recognized it as a receivable. So it is there at the end of the reporting period, that receivable is there. But
mm,
after, let's say, our 31st December, so but on February, so our authorization date is on March. So on February, I came to know that he became bankrupt.
mm,
Okay, so it is now mostly it is now probable that we are not going to get that $50,000 from him, right? So this is an event after reporting period, and it is an adjusting event because we have an evidence before the year end. Yani we have a receivable which we are expecting from him. So should can we recognize that $50,000 as a receivable now?
no.
No, because we're not going to get it. If we're not going to get it, it's not a receivable. We should write it off, right?
Mm,
So this becomes an adjusting event. So if adjusting events happen, we should adjust anything, any related thing to from the in the financial statement. So in this case, what we will do is we will remove that $50,000 from that receivables. Okay.
mm,
So adjusting events provide evidence of conditions that existed at the reporting period. Main example is insolvency of a customer. Okay. Or let's say. There is another example, which is determination after the year end of sale or purchase of the assets sold or purchased before the year end. Yani, we bought some goods, or we say we sold some goods, but we are determining the amount we got or we paid after the year end. Okay, that is also an example, mainly insolvency. And second would be this, yani second example is simple. The thing is, uh, we are determining the sales price or the purchase price after the year end. Okay, we have already
mm,
bought the good or we have already sold the goods, but we only determining the sales or purchase price after the year end. In such cases, we will any determinations and all we will adjust it in the financial statements. Just remember these two examples, that's it. And
mm,
non-adjusting event would be mainly, main example is flood, fire, and or major purchase of or disposal of assets, or we acquired a subsidiary, or we disposed our subsidiary after the year end. So these are non-adjusting events. Main thing is fire, flood, and all those things. Okay, those things, if anything happens, let's say a fire happened after the year end, it is a non-adjusting event. Let's say the fire destroyed the inventory of worth $50,000.
mm,
Okay, so we should not go back to our financial statement and reduce that 50,000 inventory, write off that 50,000 inventory. No, we should not do that. Okay,
mm.
this effect will only come for the next year financial statements. Okay, in the next year financial statement we'll remove it. Okay,
Okay.
non-adjusting,
Mm,
we won't adjust
mm,
anything in the statement. Adjusting, we will do the necessary adjustments. Now, in case of non-adjusting events, we won't do any kind of adjustment, as I already told you. But let's say
mm,
if it is material, the if let's say the fire I told you about was really material. It nearly destroyed more than half percentage of my inventory. Okay,
mm,
in such cases, we won't do adjustments. That stays like that. We will just disclose it. Okay, we'll just
mm,
disclose it in our notes to account sheets. Fire had been the fire had occurred, a fire was there, broke out, and we this much inventory was lost. We'll just disclose it if it is material. Otherwise, no adjustments. Okay.
mhm, mm.
uh okay, this is all about IAS 37 and IAS 10. There are a lot of theoretical thing we discussed here, because usually in all the standards we don't have to discuss lots of definitions and all, right? In IAS
Mm.
37 you have a lot of it. So okay, so we will do some questions. Do you have any doubts here regarding any definitions or anything?
No, it's fine.
Okay, so okay, we'll do some questions. Where is it? Yeah. Here. Okay. Candle company is being sued. Okay. Okay, just give it a try.
What is the amount of the provision that should be made in accordance with IAS 37? Okay. And the company is being sued by the customer for 2 million for the breach of the contract over the cancelled order. Mm-hmm. Has obtained legal opinion that there is 20% chance that the candle will lose the case. Mm. Candle have provided 4 lakh 2 million to the IAS.
See, in case of legal cases and all, there
Mm.
is, they're giving you a lot of percentages and all. So we usually, when we see percentage, we just go and find out the expected value or no. That's not required. So in legal cases, you are either going to win or you are going to lose. If
Mm.
you're going to recognize, you don't have to do anything. If you're going to lose, you have to recognize the provision. Okay. Yeah, did you remember that thing?
4 lakh?
Wait. No, 4 lakh is not the answer. I told you, you're either going to win or you're going to lose. What are we going to? What is going to happen here? Are we going to win or are we going to lose?
Win.
Win. So should you
Mm.
provide any kind of provision if you're going to win?
Mm. Only disclose, I believe.
No, you don't have to think about that and all. Just tell me whether you're going to win or lose.
Win.
You're going to win. So if you're
Mm.
going to win the case, then what's the point of recognizing a liability or a provision? No.
Mm.
But
No.
you have to provide. So we can't leave this thing blank, right?
Mm-hmm.
There is something else here. they are telling you about a cost here, which is unrecoverable legal cost of defending the action. Yani, whether you're going to win or you're going to lose, we will incur a legal cost of $100,000. This is pakka. This is unrecoverable legal cost.
Yeah.
So we should provide provision for only this cost.
Okay.
Okay,
Mm.
understood?
Mm.
Okay. So why didn't we recognize a provision for the legal case?
Because we are winning and
Yeah, we are winning. There is no
mm,
liability now. Now, okay. Next question.
how should 2 million future costs be recognized? During the year, Peter Lee Company acquired an iron ore mine at a cost of 6 million. In addition, when all the ore has been extracted, the company will face the estimated cost for landscaping the area affected by mining that have the present value of 2 million. These costs will have been incurred even if no further costs were extracted.
So they're asking you how you should treat this 2 million future cost. So
Mm.
first, you know this thing. This is a future. We have to landscape the area. So basically, what cost is this?
Present value. Oh, we have to discount it, right? And the company will pay the estimated
Uh,
cost affected by
So they have
mining.
told you something. It is a present value. 2 million is not future value. It's a present value. They have
Mm.
already discounted it for you, and they're telling you the present value is 2 million.
Okay.
Okay.
That is
So
mandatory cost.
yeah, it is a mandatory cost. It will have to be incurred even if no further ore was extracted. So basically, this cost is something that we have already learned. In future we
The,
have to landscape the, yeah, dismantling cost. Remember,
mm,
that is what it is. See, estimated cost of landscaping the area affected by the mining. So
mm,
it's not just destroying, or we have to restore the land how it was. So those are all a part of dismantling cost. So we have given the present value of the dismantling cost. So usually how will we treat the dismantling cost? First option, read the first option. Provision 2 million or 2 million capitalized. Provision 2 million or 2 million charged operating. Accruals of 200,000 per annum should not recognized as no cost as arise. Which of the four one?
first one.
Yeah, first one. Because what we do, whenever a dismantling cost comes, dismantling cost should be capitalized, right? Present
Mm,
value of dismantling cost should be capitalized, yes. So obviously we should 2 million should be capitalized as part of cost of mine. And we should also create a provision. Okay. So you see this thing, ACCA examiners report June 2019. So this question was asked on an exam.
mhm.
Okay, if any questions are asked, you will see something similar to this here near the marks.
Okay.
In this case, you have otherwise it's not asked for the questions. You will have only few questions like that, which has been
Mm,
asked exams. So this one is. Are you? Did you understand this thing? How why we have
mm,
treated this as per the option one?
yeah.
Because present value of dismantling cost will form a component of the cost, which should be capitalized, and we should
Mm,
obviously provide a provision. Okay. Now read this thing. They are asking you whether the provision is required or not required. Read the four statements and okay. Read the four statements and just look out whether the provision is required or not.
Extra company and company policy of cleaning up any environmental contamination caused by the operations event. Provision required.
Yeah. Why?
Because it is must chore to do.
No, it is not must. They're telling you it is not. You're not legally obliged to do it. So
No, even though it is not legally obliged.
there was a
Because
name
they
for this
have
kind
their
of obligation.
mm,
I think I'm testing your memory too much today.
yeah, and I'm very sleepy today.
No, there's a name for this obligation.
I don't remember it then.
You see this, they're telling you there, the company has a policy of cleaning up, policy, past practices, or any kind of statement that you've done. There was an name for that obligation. Constructive obligation.
Mm-hmm. Sure.
Yeah, I will send you the PDF of the after the class. Okay.
Okay. You did
Okay.
not say it there as well, I believe.
Yeah. Okay. So we had three obligations. It can be either present, legal, or constructive obligation. In such cases, we have to provide provisions. Okay. In this case,
Mm.
there is a constructive obligation. That's why we are providing a provision. Okay. Okay. Now, second
Okay.
statement.
Some company have a fixed price contract to supply widgets to the in company. Now company has calculated that it will cost more to manufacture the widgets than budgeting, which is more than adequate provision.
Yeah. What is this thing?
Estimated cost is budgeted cost is more than actual cost.
No, budgeted cost being cost more than budgeted. It's not required.
It
There is
has
you should come
calculated cost.
cost greater than revenue. They've told you which is more than the
Mm.
revenue agreed from a rental company.
Okay, cost is more to manufacture. Yeah, okay.
So what do you call this type of contracts?
Today.
Hon-
Yeah.
Onerous onerous contracts. Okay.
Okay. Yeah. Cost
Okay.
is
So the
greater than
first
benefit and more
first one
costly
was
method. Hmm.
constructive obligation, which
Hmm.
arises out of policies, past practices, or any statements they have given to the other parties. Second one is on an onerous contract, which wherein cost is greater than the benefit. Okay. Okay.
Hmm.
Read the third one.
Provision.
Okay. So they are closing down a division, right? So we are
Hmm.
talking about what restructuring.
Hmm.
Okay, we can only provide provision for restructuring if two conditions exist: detailed formal plan and announcement to those affected.
Okay. They have not done that.
Yeah, they have a detailed closure plans, but they have not yet communicated. So should you
Hmm.
provide a provision for it?
No.
No. Okay.
If the company has acquired a machine that required the staff to be trained on its safe operation, the staff training will occur in the next financial year. No.
No, no, no. Yeah, that is yeah, we should not provide any kind of provisions and all for it. Okay.
Hmm.
So because staff training we will not provide anything, right?
Hmm.
Okay. Now 118.
We did this, right?
We have flute company. Ah, yeah, we did this. 119 then.
The provision should be made for both constructive and legal obligations. Yeah.
Yes, true. It should be made.
Discounting will be used when estimating the amount of provision. Yeah.
Yes.
Future value discounting. Okay. The restructuring provision must include the estimated cost of restructuring or relocation of continuous staff. Yeah.
Yeah?
Or relocation. No, no. Training cost and relocation cost. No.
Yeah. So it is false.
False. The restructuring provisions may only be made when the company has detailed plan for restructuring and communicated with the interested party. Yeah. True.
Yes. So you understand the application of the theoretical part of IS 37 now. They're asking you a
Hmm.
lot of true and false, right? So that is
Yeah.
why all those theories are needed for IS 37. Okay.
Okay.
So 120.
Hmm. That is the case for 120. The company has a provision of 1 lakh.
So is this an adjusting
Um,
or non-adjusting event?
Interesting.
Yeah. Wait. What is our year end? 31st December, right?
Hmm.
Oh, I think they're not talking about the. No, we don't look at this thing. Anyway, we will have to do some kind of treatment here.
Hmm.
So here they're telling us that we have provided a provision of $100,000, okay, at the year end, but that was December, and it is relating to an ongoing court case. So on 10th February, like yani the next year, we settled this case for $120,000. How much did we recognize for the case? hundred thousand
1 lakh.
dollars.
Hmm.
Yeah. For how much did we settle? What was the amount we settled it for? $120,000. So just look at these two things. So there has been a 20,000 increase than we have expected. So read the journal entries. Debiting provision 100K, debiting profit or loss, which is as an expense 20,000, credit cash 120,000. Okay. So here anyway we are settling the amount, right? So cash should be credited or debited.
Credited.
Credited. In this case, this is the only option where cash is being
Yeah.
credited. Okay.
Hmm.
You can do this questions in such ways, because if you know just one thing, that's fine, because in this case we only looked at the crediting cash, right? So we got the answer directly. Let's say if you're going to go in detail, we are debiting provision because obviously provision is credit nature, right?
Hmm.
So if we have to remove provision, then we'll have to debit it. So
Yeah.
we'll debit the provision and remove the provision. And we
Hmm.
have incurred a 20,000 extra 20,000. It was an
Hmm.
expense for us, right? It was more
Hmm.
than what you've expected. So it will be debited and we will credit cash 120,000. Is this clear?
Hmm. Yeah.
Okay. Mm, so rest of the thing, just look here. They are crediting provision. No, you can't credit provision because you're adding additional 100,000. In this case,
Hmm.
also no. In this case, they're debiting provision. They're crediting expense. See, we have paid cash, right?
Hmm.
We won't credit expense. We debit expense, right? So that's wrong. So anyway, 121. No,
What is the total provision with the insurer company will report its statement of financial position as on 30 September. Total provision. Okay. In 1st October 2013, insurer company commenced selling the registration cost, ignore discounting, 10,000 per million. Mm-hmm. It will also require to dismantle drilling equipment at the end of the year. Since it has an estimated cost of 30 million and 30 external cost of 28%. Okay.
see, do you know the discounting factor here they've given you?
No.
See this thing. $1 has a present value of 0.68 in 5 years time.
Hmm.
This is the present. This is the discounting factor 0.68, because they're telling you that after 5 years, if for $1, no, $1 after 5 years would be 0.68 now.
Yeah.
So this is the discounting factor here. Okay, or else you can just find normally like how you do. But still they've given you directly, right? So why waste time?
Hmm. 1 million is. Yeah, Allah.
Yeah, there's some kind of zero troubles here.
47,032.
Nope. Hey,
No, then.
by the way, here, be careful with the zeros, okay?
Mm,
You can either convert this into 10,000 range, yani you can do everything by 000, or
mm,
take 10,000 as million. I took 10,000 as million. It is easier because everything else is in million, right?
mm.
So 10,000 is 0.01 million.
Yeah.
For
Still, I get
let's
25.
wait. Let's look at this. We have on 1st October 2023, and our year end is 30th September. So, yeah, this is the year beginning. So, we will have a restorative cost, ignoring discounting. We have 10,000 million per million barrels of oil extracted. How much of barrels have we extracted? 250 million. So, for 1 million, we will have $10,000 cost. So for 250 million, how many dollars of cost will be there? 10,000 into 250, right?
Yeah.
That will be the cost for extracting 250 million barrels. So for
Mm,
10,000, since there is some zero thing trouble here, we'll just directly multiply 250 into 0.01. Okay,
yeah.
so
Mm,
0.01 million for 1 million barrels. Okay, 0.01 dollars million for 1 million barrels will it will cost 0.01 million. So for 250 million barrels, it will cost 250 into 0.01 million. Understood?
mm,
Basically, it's like for one chocolate, 5 rupees. For 10 chocolate, it's 5 into 10. That thing. Okay.
mm, mm.
So you will get restorative cost, but then there are other costs. Yani dismantling cost is also there.
Yeah.
So what was the present value of the dismantling cost?
And that I got as 22.032.
Uh, you multiply 30 with what?
0.68.
And you got how much?
Okay. You want that answer. 20.4.
20.4. And then you add up the interest?
Yeah. At
Uh,
8%.
8 percentage. So 26.164 would be, you will get.
Uh, yeah. 30
Okay.
into 0.68 is 20.4. Add 8%.
You
22.032.
you get 20.4 into 0.08.
No, but you just have to directly add 8%, right?
Actually, I just directly added up in my calculator. Yani 30 into 0.68 plus 30
Mm,
into 0.68 into 8 percentage.
yeah.
22.032. Oh, wait. And then you add up 250 into 0.01. Yeah, 22 point, what was that? 22.038, right?
Yeah.
Yeah, 22.038. Oh, my fault. Okay. So you got for this as a whole, you got 22.038. They're asking you the total provision that I should give for extraction plus dismantling.
Mm,
So the extraction, you will get this much, and for dismantling, you will get 22.03. Just add up both of it and you will get the answer.
24.532.
Yeah, 532. That is in millions, right?
Yeah.
So here they're not asking you whether you should write, if there is an M here, you just write 24.532. But since there is no M, you have to write the full amount, yani 24,532,000. Okay, understood?
Mm.
So this question had lot of informations,
No,
right?
but I just did a mistake, like 2.5 kilogram to 25 because
I
of
think
that
you made
zeros.
mistake here, right? Yeah,
Hmm.
zeros can be
Right.
confusing. Zeros are important. Okay.
Yeah, I got you.
So okay. So okay, now 122 we already did this. 123.
Okay, one second. Which two of the following events which occur after the reporting date of the company but before the financial statement are to be authorized for issue are classified as an existing event. The change in tax rate announced with the reporting date but affecting the current tax liability. The discovery of the fraud that has been occurred during the year. The omission of sale proceeds of the item sold before the year. The restriction of the factory by fraud. The discovery of fraud occurred during the year.
Yes.
The destruction of fire factory by fire.
They're asking you adjusting events. And I told you specifically for non-adjusting events, fire and flood. All these things won't affect.
Okay,
S- So this is definitely not the answer.
fire and flood won't affect. Okay, the destruction of the sale proceeds and item.
And yeah,
Oh,
there is one option here which I've given you as an example for adjusting events. I told you two examples for adjusting events.
mm-hmm. I guess I need a coffee today.
Okay, this one. Determination of sales proceeds of an item of plant sold before the year end. I gave you an example, right? We have bought some plant, if we have bought some goods or anything, or we have sold something before the year end, but we haven't determined its purchase price or sales price. We are determining the sales or purchase price after the year end. In such cases, that becomes an adjusting event. So, purchase or sales of a determination of purchase price or sales price of the goods we have sold or bought before the year end. It is an adjusting event. Okay,
Mm-hmm. Mm-hmm.
this one have no effect. This is not. This is a non-adjusting event. These two are the answer. Okay, this was an example I explicitly gave you, and the other example was insolvency of a customer. Okay. Uh,
Insolvency customer. Okay.
okay. This one. Yeah, this will be our last question.
The financial accounting is maintaining with any other event something required adjustment. Okay.
So they're asking you require events that require adjustment. Basically, they're asking for adjusting events.
Insolvency. First one.
Yeah, first one.
Mm. Mhm. Yeah, last one.
So when did they make the public announcement?
Oh, after. No, no. Okay.
No. So this is not the answer.
Second one.
About second one. Mm, okay. Which is our year? 31st March. So following an industrial accident on 10th April. So did we know that on 31st March, that did we know that an accident is going to happen on 10th April?
Mm-hmm.
No. So this adjustment is purely for next year. Okay,
Then
let's say this has happened before the year end, and the case was going on, some kind of provision we have recorded, and only on, let's say, on 10th April the word came and we had to pay this much amount. In that case, maybe it will be adjusting, but in this case, no. The industrial accident, the event itself happened after the year end.
mm,
Okay. And about this one, so finally, this is the only thing happened left. Inventory was held at cost of 200 on 31st March and was sold on 21st April on $150,000. So this will be what? NRV. Okay, and this is cost. See, the NRV is lesser than the cost.
mm.
Okay, so in case of inventories, just know that in case of inventories, after the year end we will so this is something that you learn at audit or audit and assurance paper. You see this thing, there are a lot of things they have learned about this, lot of procedures. And also in such cases, inventories, you know what our auditors do? Let's say our inventory was held at a cost of $200,000. So the auditors
Mm,
will come and check out any post year and sales receipts. Okay,
mm,
because they want to know if everything is valued correctly, whether everything is done as per standards. So they will take some post year and sales receipts, and they will check out whether the amount at which the goods was sold. So in this case, let's say our auditor found out that it was sold at $150,000. So the NRV is lesser than the cost, right? So this is an adjusting inventory. So as per IAS 2, we should always show inventory at lower of cost and NRV.
mm,
So this is before the authorizing of the. We are talking about this period is reporting. This is a subsequent period. So at the subsequent period, we realize that the inventory that we are holding at a cost of $200,000 is only values $150,000. We can only sell it for $150,000. So we are overstating our inventories there. So we will write down our inventory to $150,000. Okay, this is a case of inventory. We will always check for NRV and cost. So during the subsequent period, we will check whether the NRV is greater or lower than the cost. So if it is lower than the cost, then we will we will write down the inventory. Okay, in this case, we will write
mm.
down the $200,000 inventory to $150,000. So inventory change in NRV and cost of inventory, it is an adjusting event. So you got a new example here for adjusting events. Okay, we just discussed two examples, right? Insolvency
Mm.
and determination of sales, blah blah blah. Now this is another example, the
Okay.
post year and NRV, checking out the post year and NRV. Okay, this is it. So do you have any doubts in any of the questions that we have done now, especially the
No,
theoretical part?
I need to buy had the slides.
Yeah, see, you will see that the theoretical part is like, they're not directly asking you what is this and all, they're just asking you to apply it. In this
Mm,
case, look at it. They know, they have told you what adjusting and adjusting event is, but they want you to apply here your knowledge here,
mm,
uh, here in this case also. So direct questions, like direct theoretical questions, is you can only expect from like true or false and all. The worst part is that for it is for 2 marks, right?
mm,
Let's say you got three of them right, but one of them
mm.
went wrong, you lose the entire 2 marks.
Oh,
Yeah, that's the saddest part, they will give you
mhm,
two in case of this one, let's see, let's check. Okay, this question, uh where is it? Okay, let's say they're asking you to choose two options. One option
mm,
is correct and the next one is wrong, you will lose 2 marks.
mhm,
So MCQs, there is the advantage and the disadvantage is that both,
mm,
disadvantage is your MCQs, you can it is better to score and it doesn't take much time. But at
mm.
the same time, when things like this come and you're not really good at
Contingent.
applications of the theoretical part, you lose the entire 2 marks.
Mhm,
you know just say, let's say you have around how many questions, 30 questions in MCQs. Okay, 13
mm,
into, yeah, 30 questions are there. So out of the 30 questions, let's say you made 5 questions wrong, just 5 questions, you are
mm,
losing 10 marks there,
mm,
right? So you can lose a lot of marks in MCQs just like that, and you can also
mm,
score good marks in MCQs. Okay,
mm.
so this is important. But in case of section C, the main advantage is this, yani you will get marks for every working notes that you do. Okay,
Check
that's
marking.
the main
Mm,
advantage of section C. Okay, it's
mm,
not like they're not going to look at the end result. Yeah, obviously they will, you have to have mark for the end result and all, maybe 1 mark, half 1.5 marks, 2 marks and all. But for the entire workings that you do, you will have marks will be allocated for everything. Okay, in case of FR, you will,
mm.
for consolidations and all, you will have to learn 5 working notes and all those working notes, everything that you do counts.
Okay. Mm,
It's not about balancing and all, it's more about doing the you may not be able to, if you get SOFP, you may not be able to balance and all. Some, the
mm.
mostly people don't get, you don't we won't be able to balance the the statement of financial position, but still they will get marks because of the workings they've done. Okay,
Mm.
yeah, this is it about IAS 37. So uh wait, is it okay? So I'll send you the PDF after the
Mm.
class. I think we don't need to revise now because you're you're entirely sleepy now. Okay.
Mm.
So you're still in La La Land. So once you come back, we will maybe we'll do in the next class or something.
Yeah,
Okay.
I will revise. Like, we don't have class tomorrow and like and
No, no,
Friday as well, right? Then I can
we
have
don't have.
time